Now let's bring in our first guest who expects the market to remain choppy this year, but says the bottom is in. Morgan Stanley Wealth Management Managing Director Dan Skelly with us now. Dan, welcome. So you also seem to think the highs are pretty much in and we're near them overall. So how should investors position themselves now to be ready for 2026?
Sure, John. Thanks for having me. And so, look, this year is shaping up to be like a range-bound environment, which at its core frustrates everyone, right? The bulls get frustrated that you don't sustain much momentum past this kind of 5,900 level. The bears get frustrated that they can't push their shorts much below the 5,200 level. So we are in a range, and it's capped by this idea that the full extent of earnings downgrades hasn't really happened yet. We don't know the final clarity around where tariff levels will finally net out. And in the best case scenario, they're going to be substantially higher still than they are over the last several years and decades. And then lastly, the low end of the range holds because of continued labor market resilience in the economy, of this idea that the AI adoption cycle is just starting to take hold, which will eventually be good for the earnings cycle, and the market's going to sniff that out. And last but not least, the White House team has shown some flexibility around the most maximal positions.
So that's talking S&P and range bound. What about this mix between domestic and international? International has been doing better over the last couple quarters, especially to start 25. Should investors believe overall that despite all of this tariff uncertainty, that shift toward better international performance continues or no?
So from the institutional perspective, Morgan Stanley has just put out its mid-year update, and the team is preferring U.S. stocks over rest of world, specifically U.S. over Europe. And look, European equities, which you had referenced, had been on a really big hot streak, could also see potential growth in earnings downgrades as the trade battle ensues. And the last thing I would say is you haven't really even seen a pickup in sustained capital flows. I think there was this massive chorus, this very loud chorus in early April around sell everything America. And we just haven't seen that corroborated by the actual data in terms of inflows. Flows into the U.S. market are still tracking pretty strongly year to date. I guess the very last thing I would say is coming back to tech. In the last quarter, we saw the Mag 7 have its best upside surprise in earnings really in the last 2 to 3 quarters. And that clearly is another area of uniqueness of defensive and offensive attributes that other parts of the world don't have.
So if we stick with tech here, how do you factor in the anticipated effects of AI to this market and to the economy and the realization of all of the investment that we've seen thus far? Because on the one hand, Jamie Dimon, in my interview with him on Friday, was saying, we're not going to see it, at least not this year, not yet, any deflationary effects from AI adoption. On the other hand, I was speaking to tech investors, including Joe Lonsdale, who says, look, AI is going to spike productivity and it's going to more than offset the impact of job losses as companies adopt AI too. How do you think about it?
Such an excellent question, Morgan, and a couple things to unpack there, right? So in the first quarter, the Magnificent Seven as a group reported 32% year-over-year earnings growth. The S&P 493 was around 8%. So you're still seeing 4 times the amount of growth coming from Mag 7 than the rest of the market. And look, importantly, as you alluded to, let's go back 6 to 9 months ago. The Mag 7 included not just the beneficiaries, but the biggest spenders related to AI. And as that group took a breather 6 to 9 months ago, people were still waiting for the return on investment. Now you're finally starting to see that play out, not just, again, within that same group of the spenders as well as the beneficiaries, but it's broadening out. You're seeing it in software. You're seeing it in consumer internet within the tech space. And then to your question, we do think coming in next year in 26, you're going to finally start to see the Fortune 100 start to better quantify and thus validate AI adoption. That's going to play out across financials, manufacturing, and healthcare.